Hi, welcome to the webinar today. We are very happy to have you with us. We have with us today Rick Gann from 1031 Capital Solutions, and he's going to be covering some of the regulatory updates and rules that really all of you here on the call should know about 1031 exchanges. So some of it might be review, some of it might be new for you. But then what I really like about this particular presentation is Rick is also going to go over some of the risks and pros and cons of investing in single tenant net leases through a DST if you did a 1031 exchange, or if you 1031 exchange directly into those properties, and whether you should stick to residential or not. I think it'll give you some insight there. So the other thing I want to do before we start is just let you know that we will be recording this whole thing, so you'll get it tomorrow. We also will be taking questions at the end of the presentation, so stick around and you can put your questions in the question box and we can take a look there to make sure your questions get answered. And then lastly, a short introduction about our speaker today, Rick. Rick is an attorney, a licensed real estate broker, and general securities principal specializing in 1031 exchange solutions. And he's the co-author of the book, How to Retire from Being a Landlord. Before transitioning to financial services, Rick practiced real estate taxation and estate planning. And starting in 2006, he developed a retail division of Grubb & Ellis offering 1031 exchange solutions. He also created a new 1031 exchange program for individual investors seeking to co-invest in REIT-owned properties. And today, he works with 1031 Capital Solutions, and he is your go-to guy for 1031 exchanges. So he's the perfect person to talk about this topic. And with that said, I'll pass it over to you, Rick. I am really glad that you're able to come today and make the time.
Well, thank you. Thank you so much, Alexandra. That was a kind introduction. Hello, everyone. Thank you for joining us on this hopefully beautiful October day, wherever you are. I hope everyone on this call is healthy and safe. We would like to thank AOA for giving us this opportunity to speak with all of you today. And as always, we greatly appreciate all the great work that Alexandra does on behalf of the association. Again, my name is Rick Gann. And in case you're losing track of which webinar you're on, today I will review 1031 exchanges, provide a regulatory update, and then discuss why we believe certain types of real estate may fare better than others in our current inflationary environment. Before we go any further, I am required to tell you that this presentation is not a solicitation. Real estate and real estate securities may not be suitable for all investors. The risks of investing in real estate programs are no less than the risks of direct real estate ownership. Investing in real estate securities programs typically involve higher fees than traditional investing. As in traditional real estate, there are no guarantees as to principal or income. And finally, although the name of our company is 1031 Capital Solutions, we do not give tax or legal advice. My office is in Lake Oswego, Oregon, just south of Portland. My business partner, Jason McMurtry, is down in San Diego County. And we also have satellite offices in San Francisco and Seattle, as well as team members who work remotely from Denver and Orange County. I am an attorney by trade, as Alexandra mentioned. My partner, Jason, has an MBA, and we both have been working in this industry together since 1998. I encourage everyone to visit our website, 1031capitalsolutions.com, where we have copious articles and blogs and videos and great educational content. It is a great one-stop shop for 1031 exchange information. In a nutshell, we are a financial services firm that exists for the purpose of helping individual property owners retire from being landlords. And on that note, in May of 2020, we published a book on this very topic, which is available in both print and electronic formats on Amazon. And at some point, Alexandra is going to post, there it is, an opportunity for you to indicate if you'd like to receive a copy of the book. And so we are happy to provide you a free hard copy of the book. We just need We just need the request and your address. But if you insist on paying for it, feel free to find it on Amazon. All right, with that, before we dive in, I thought I'd kick off our discussion with an actual Jeopardy question. This question appeared on January 7th of this year under the category of "It Was 1970s America, Man." And on that same night, Amy Schneider became only the 5th contestant to become a Jeopardy millionaire. Now, does anyone know the answer, or technically the question? Yeah, the answer is, what are property taxes? And I share this because when your grandfather is one of the most famous tax crusaders in the country, you end up knowing more about property taxation than any child should have to know. And so it's no surprise today, 44 years after Prop 13, that I'm still spending every day talking to people about how their real estate is taxed. All right. You may not be aware that over the last 18 months, the US experienced the highest volume of 1031 exchange transactions in history. Last year, our firm helped 93 landlords, just like the folks on this webinar, invest in over $140 million of 1031 replacement properties, and we easily will top that record this year. Well, what is driving all of this activity, you may ask? Well, here are some of the most common reasons that folks are exchanging their self-managed properties on the West Coast for passive investments in more landlord-friendly states. And as all of you know, the hassles of being a landlord are not getting any easier. So that in and of itself is a highly motivating factor. People who simply just want to improve their lifestyle. But on top of that, we've got state and local landlord regulations and rent control. Some might say that certain state and local governments have essentially declared war on residential landlords. There's never been greater legal liability associated with being a landlord, and particularly being a rental housing provider. A lot of people are scared of the fact, and they should be, that net migration in some areas is negative. We've got more people leaving parts of California than are going there. Things aren't much better here in the Pacific Northwest. We've got, of course, taxes going up everywhere. And at a microeconomic level, for a lot of people, the yield that you're getting on the equity in your rental property just may be unjustifiably low, especially in light of all these other things we just mentioned. So a lot of reasons driving people to consider selling their self-managed rental properties and reinvesting in greener pastures. Well, one of the most common pitches you'll get from a real estate broker in this situation is to sell your rental housing property and exchange it for a fast food restaurant or dollar store. Now, while we of course agree that a 1031 exchange may be appropriate, as we'll discuss, we continue to believe that sectors like apartments and self-storage, frankly, are better positioned for today's economic environment than many single tenant triple net lease options. But before we talk about the what of 1031 exchanging, let's first talk about the how. And we'll start with a quick review of the fundamental rules regarding 1031 exchanges, including basic tax benefits, which properties qualify. We'll talk about equity, debt, and boot, QIs, identification rules, and deadlines. So on basic tax benefits, and I know most of you probably already have your head around this, but in the absence of a 1031 exchange, you are subject to 4 categories of taxes: long-term capital gains, depreciation recapture, NIIT tax, which is only a few years old, and of course, your state tax, if applicable. Now in California, these combined taxes can be as high as 40% of your gains. And for folks who may have refinanced their rental property along the way, the tax bill can actually exceed the net proceeds of their sale. Of course, the point of doing a 1031 exchange is to defer as much of these taxes as possible today, and then ultimately avoid them altogether. As you probably know, tax-deferred exchanges for real estate have now existed for over 100 years. And under Internal Revenue Code Section 1031, when you sell and then buy investment real estate, you can, one, defer up to 100% of your capital gains taxes, including depreciation recapture. Two, continue deferring over an unlimited number of successive exchanges. And three, ultimately avoid taxation of your property at death by virtue of what's known as the step up in basis. Collectively, this is known as the swap till you drop strategy, meaning that if you do an exchange today and continue to do 1031 exchanges over the course of your life, and then pass away with highly appreciated property, your heirs can inherit that property and shortly thereafter sell that property and have no capital gains tax consequences. Don't let any socialist DC politicians tell you this is some unfair loophole. Any tax benefit that requires you to die is not a loophole. So what can you exchange under 1031 rules? Because not every piece of property is available for a 1031 exchange. First, you have to have the intent to own a property for investment or business use. You have to have the intent to own a property for investment or business use. Thankfully, all real estate is like kind with all other real estate. So when we talk about doing a like kind exchange, really that means selling investment real estate and buying investment real estate. All real estate is like kind with other real estate. However, as I alluded to, personal residences, vacation properties, and inventory are excluded. The first two are obvious. When we talk about inventory, what we mean is developers and flippers who buy property for the purpose of improving it and then shortly reselling that property. They are not able to take advantage of 1031 exchanges because, again, they are not intending to hold that property for a long-term investment or for business use. They're buying and selling that property as quote inventory and therefore cannot avail themselves of a 1031 exchange. You cannot sell a property and then buy shares of a limited partnership or an LLC or a REIT. None of those types of investments are deemed to be real estate under IRS rules, even if those entities own real estate. The only example of where you're able to sell a property that was in your name, or perhaps your trust name or your LLC name, and then buy interests in an entity in exchange in a 1031 exchange transaction, the only example of that is allowed is a DST, a Delaware Statutory Trust. Otherwise, when you invest in real estate in a 1031 exchange, your name has to be on the title to that property, just like the property you sold. Now remember, to have a fully tax-deferred 1031 exchange, you must replace the entire value of your relinquished property. You are allowed, of course, to deduct traditional transaction expenses, but otherwise you must buy at least as much real estate as you sold. More specifically, you must replace all of your equity with equity, and you must replace your debt, if you had a loan, with either cash or another loan. remember, whatever you sold, you have to replace. If you netted $1 million on the sale of your property, you have to buy $1 million worth of property on the other side of your exchange. If you paid off a loan and you only ended up with $500,000 in your qualified intermediary account, not only do you have to reinvest all of that $500,000, you still have to replace the loan that you had on the property you sold. Just remember, you have to replace the value of the property that you sold. Any shortfall in value between your relinquished property and your replacement property is known as boot, and boot is subject to taxation. As you all probably know, when you conduct a 1031 exchange, there is a special escrow requirement under IRS rules. A qualified intermediary, also known as an exchange accommodator, or as we say, a QI, must receive and disperse your exchange funds on your behalf. If you sell your property and the proceeds from your sale go to you first, you're done. You can no longer do a 1031 exchange. And unfortunately, we'll have clients call once in a while and say, hey, I'm doing a 1031 exchange, and I'll spend a bunch of time on the phone. And then I'll say, oh, by the way, who's your qualified intermediary? And they say, what's that? And then I know at that point that it's too late for that client to do a 1031 exchange because they touched the money. So it's a simple rule, but you have to pre-establish a qualified intermediary or QI account with one of the firms that provide these services in advance of your close date, so the funds from your sale are held by a QI who ultimately reinvests your proceeds into your replacement property or properties. Most QIs charge between $800 and $1,500 for a basic exchange transaction. In a 1031 exchange, after you sell your rental property, the IRS requires that you commit in writing to a limited number of replacement properties. On a form known as an ID letter, you have 3 options for how much real estate you can identify. The first option is known as the 3-property rule. Some of you are probably familiar with this. This is the most common rule that is used, and it basically does what it says. You can identify 3 properties of any value on your form letter, and there's again no limit on the value of any one of those properties or the total value. But of course, you have to buy at least one of those properties when you complete your exchange. The second rule that we see is known as the 200% rule. Under this rule, there's no limit on the number of properties that you can identify. So you can have 7 properties on your ID form, but the total value of those properties cannot exceed 200% of the value of your relinquished property. And this is commonly used when we are helping clients invest in DSTs that include multiple properties within each portfolio. Between the 3-property rule and the 200% rule, that covers 99% of people doing an exchange. Then there's the default 95% rule, and which really should be called the 100% rule, because basically what that rule says is you can name as many properties as you want with unlimited value as long as you buy all of those properties, meaning you have to acquire everything that was on your ID form. And sometimes we have to rely on that rule as well. Bottom line is there are limits to what you can identify, and you want to make sure you're working with a qualified advisor before you put that ID letter together. Now, there are 2 very important deadlines you must follow when conducting a 1031 exchange. First, you submit the ID letter that we just discussed no later than 45 days after you close the sale of your relinquished property. That means the letter must be complete, signed, and received by your QI by that date. After the 45-day deadline, you can only acquire what's on that ID letter. You're committed at that point. Second, you must complete the purchase of your replacement property within 180 days of your original close date, or before you file your taxes for the year you sold the property, whichever is earlier. So this issue starts to crop up around now in the last couple months when folks are selling a 1031 exchange property and they think they've got 180 days, which you do. But if you file your taxes next year before your 180-day deadline, that will shorten the time that you have to close. And someone who isn't aware of this rule could inadvertently blow their own exchange by filing their taxes before they've completed the acquisition. So that is a really rough way to find out that you are going to incur possibly hundreds of thousands of dollars of capital gains taxes. Now, at 1031 Capital Solutions, our clients are not concerned about the 180-day deadline because most of our clients are completing their entire exchange within the first few weeks of selling their rental properties. Now, in all cases, unless there's been an emergency declaration from the federal government, like there was with COVID a couple years ago, there are no extensions allowed for these deadlines. Even if your 45-day deadline is Christmas or Rosh Hashanah or Super Bowl Sunday, you have to get that ID letter in on time. Okay, so those are the basic rules of 1031 exchanges. Let's talk for a minute on recent changes to 1031 or other capital gains taxation. First of all, a few years ago, Congress amended the 1031 rules to limit exchanges only to real estate. And it used to be that you could exchange cattle for cattle or tractors for tractors or airplanes for airplanes. All of those rules are gone now. Today, 1031 exchanges are limited exclusively to real estate, that's okay because with everyone on this call, we are all real estate investors, and we're probably not worried about the ability to exchange our cattle for other cattle. Secondly, qualified opportunity zone funds are available as a backup strategy to a 1031 exchange. And that's the subject of an entirely different webinar, but these came into existence just a few years ago, and we continue to help some clients who, for whatever reason, blew a 1031 exchange or changed their mind on doing an exchange, what have you, and using the qualified opportunity zone funds as a backup. Also, we have clients who have incurred significant capital gains on assets other than real estate, which ties into my first point. So, maybe you did sell a business or stock or something that would have otherwise triggered a significant gain. And under the qualified opportunity zone rules, we can invest those gains into a qualified opportunity zone fund and defer those taxes and get some other tax advantages on that investment. So again, that's a new development in the last few years. We've done a little bit of that business ourselves, and we anticipate Congress is going to extend the original legislation that put these QOZs into place so that we can continue to help people invest in qualified opportunity zone funds. You're welcome to learn more about that on our website or reach out to me to have a conversation on qualified opportunity zone funds. And then finally, the accelerated depreciation rules that allow for a 100% write-off in the first year for certain types of assets. That advantage expires at the end of this year. I don't anticipate that Congress is going to extend that. I've been seeing some other emails and notifications and webinars trying to encourage people to take advantage of the accelerated depreciation rules for, again, being able to write off in your first year of acquiring an asset the depreciation that otherwise would be extended over time. This is another concept that we could spend a whole hour talking about separately, but just be aware that the ability to write off in your first year what would otherwise be a multi-year depreciation schedule, that is going to end at the end of this year. And then there are several alarming elements to the tax proposals that came out of the White House last year. But for purposes of this call, they include one, increasing the top marginal capital gains tax rate to 31.8%, which would place the US in the top 3 highest capital gains taxing countries in the world. Two, limiting the step up in basis at death to a total of 1 million, so that heirs would have to pay taxes on any unrecognized gains in an estate that exceed $1 million. And finally, 3, limiting the total amount of unrecognized gains that can be deferred in a 1031 exchange to $1 million per couple per year. Thankfully, none of these proposals made it into the so-called Inflation Reduction Act, but the results of the upcoming election obviously will determine whether some or all of these proposals will find their way back into legislation in the next Congress beginning in 2023. So again, a sigh of relief that these proposals were not enacted in the current Congress, but we are ever vigilant in paying attention to all the rules and regulations that could affect us and our clients with regard to capital gains tax. Okay, with 1031 basics out of the way, let's switch gears now from the how to the what. And specifically, I want to address head-on the idea of selling an apartment building or other rental housing and buying a small single-tenant triple net lease property. As most of you probably know, the term triple net lease means the tenant is responsible for self-managing the property and paying for the maintenance, insurance, and property taxes. And that's where the term triple net lease comes from. Unlike homes, investment properties generally trade at a price based on the property's capitalization rate, or cap rate. A cap rate is a property's projected 12-month net operating income divided by an actual or proposed purchase price. And I know in talking about algebra, I'm already losing some of you, but stay with me. Now, a typical example of where you might hear the term cap rate is somebody could say, maybe it's a broker, the Class A office market in the CBD is trading at a 5 cap. Now, translated from broker speak, this means that all of the newer office buildings with modern amenities in the central business district that sold recently were purchased at an average price in which the projected 12 months of net operating income for each property was 5% of said price. That's what we're saying when we're talking about all the Class A office in the CBD is trading at a 5 cap. So a lot of information embedded into broker speak. But it's important to understand what cap rates mean and what they don't mean. Now, remember that cap rates do not factor loan servicing, depreciation, or taxes. When we talk about a cap rate, what we're really saying is, what is the net operating income being generated by a property as a percentage of the price that it was recently sold at? If you owned a Class A office building in our example, in the central business district, and you were curious about how much your property would sell for, you would flip this formula around and divide the net operating income of your property by the average cap rate of 5%. And so the same could apply whether you own apartment buildings or a strip mall or whatever type of real estate you're investing in. If you want to know what your property is worth today, you take your net operating income, divide it by whatever is the prevailing transactional cap rate for that type of property, and all things being equal, that's going to give you a ballpark price. If cap rates for a particular type of property in a given location are going down, it means that buyers are willing to accept a lower net operating income relative to price. This means that all things being equal, the property value will go up even if the NOI is not changing. And we saw a lot of this over the last 10, 12 years, where property values were going up because the cap rates were going down, regardless of whether the income from a particular property was actually increasing. The expression cap rate compression, maybe you've heard that, that's just a fancy way of saying that property values are going up relative to income. Now, conversely, if cap rates are going up for a given type of property, it means that the buyers are demanding a higher income relative to price. In other words, the property value will go down even if the NOI is not changing. So what makes cap rates move up or down? Well, there is no exact science to cap rates, but we do know from academic studies that you can boil down cap rates to three factors: interest rates, available investment capital, and perceived operational risk. Now, sometimes, like we saw this year, interest rates can move up without necessarily pushing cap rates up right away. However, when interest rates double, there eventually has to be a movement in cap rates, even if there are lots of dollars chasing good real estate. The point of that is to say that, of course, interest rates on a normal basis, as they fluctuate a little bit up and down, there may or may not be an exact lockstep effect on the cap rates of real estate, because other factors like the amount of people who are looking to invest in real estate and the perceived operational risk of these different types of real estates at any given time are going to have perhaps an opposite effect on what would otherwise be cap rates moving with interest rates. So it is a complicated mix of factors. But like I said, if interest rates double, as they have done recently, there is no escape from the fact that the cap rates eventually are going to have to move up. Otherwise, why invest in real estate at a cap rate that is below the yield of, say, 10-year treasuries? So while we cannot predict interest rates, we do know that the Fed intends to continue pushing rates up in response to inflation. And for that reason, we can be confident without needing a crystal ball that in the short term, cap rates are going to have to go up for most sectors of real estate. Well, if you believe that prevailing cap rates are going to increase for a particular sector of real estate, how then will that affect the future appreciation of a particular property? And again, it's a painfully simple formula. All things being equal, if the net operating income of a property does not increase proportionally to rising cap rates, the property will sell at a lower price if it is put up for sale. Well, let's see how this works with an example from the world of single tenant, triple net lease fast food restaurants. And again, the point of this is to try to draw some attention to the risks associated with this really common sales pitch that we talked about of you sell your rental housing and go buy a fast food restaurant or a dollar store. So here we've got Joe's Tacos, and you're being pitched to buy a single Joe's Taco drive-through restaurant in Denver. The tenant, which is the local operator of the Joe's Taco restaurant, just signed a 15-year lease. And the terms include an automatic rent bump of 3% every 2 years. Now, the current rent is $150,000 per year. And based on a prevailing cap rate for similar nearby restaurants of 5%, the seller is asking for $3 million. In other words, the NOI, which is in this case, the triple net lease rent, is $150,000 per year. The seller wants to sell this property at the prevailing cap rate for similar properties of 5%, and therefore the asking price is $3 million. Under this contract, the lease agreement with the 3% bump every 2 years, as you can see on the graph, by the time you get 6 years out, the annual income will have increased under the lease agreement to almost $164,000. That all sounds pretty great. When you look at this in a vacuum and aren't paying attention to what's happening at the macroeconomic level. However, you can't buy your real estate in a vacuum. And in a very likely scenario, 2022 will turn out to have been the historic low point for cap rates of triple net fast food restaurants in Denver. In fact, 2022 is probably going to prove to be the historic low point for cap rates of all real estate everywhere in the United States. In other words, in this story, you are buying at the peak of the market. Of course, you're doing a 1031 exchange, so you also likely sold at the top. So don't kick yourself. But you have to keep in mind that that you're selling at the top and you're buying at the top of the market. However, if you intend to sell this Joe's Tacos in 6 years, it's possible that the cap rates may have climbed from, say, 5% to 6% by the time you're ready to sell. That may not sound like a lot. Okay, the cap rate went up 1%. And if you mention your concern to your broker, I can almost guarantee his response, which is to say, no problem. Even though cap rates are going up, so is your rental income. So it'll be a wash. Okay. And that is the mentality that helps people justify these single tenant triple net lease purchases in a rising cap rate environment. And of course, that could be true. That, and in this case, it is true that your net operating income is going to go up as a result of the built-in rent bumps. But in our example, the cap rates are rising faster than the rent bumps that are in the triple net lease. So in 2028, if you sell this property when cap rates are at 6%, based on the NOI of the property, your Joe's Tacos will only be worth $2.73 million. This will result in a capital loss of $270,000 or roughly 20 months of income. This is just math. And that's really what the lesson here is from Joe's Tacos. Joe's Tacos is you can't escape the basic algebra of the relationship between NOI and cap rates. Here, the NOI of the property increased by 9.28% over 6 years. That by itself sounds fine. But the cap rate went up by 20%. Because when you go from 5% to 6%, that's actually a 20% increase in the cap rate. And because the rent escalators in the lease were not enough to keep up with rising cap rates, you ended up buying and selling a bad taco. Okay, now cap rate risks are not the only challenges with single tenant triple net lease deals. When you buy a single fast food restaurant drive-through or a single tenant dollar store, obviously you are putting all of your eggs in one basket, right? All of your success in that property relies on the business success of the one tenant in the building. You have no flexibility in your total purchase price. So you sold your property for whatever price, and now you have to try to match that price with whatever these single tenant triple net lease or dollar store deals are out in the market. And most of the time, there's no match between what's available in this market type compared to the rental property that you just sold. And if you need to replace the loan on your relinquished property, you have to go through the arduous process of applying for an investment loan. Okay. These are all the obstacles, risks, and concerns of going from being a rental housing provider to buying a fast food restaurant or a dollar store. Well, to mitigate the risk that cap rates will outpace your income, we strongly encourage anyone conducting a 1031 exchange to consider properties where you have the potential to regularly increase your revenue. Examples of short-term lease sectors include multifamily, self-storage, senior and student housing, and even hotels. And while there are no guarantees of NOI growth, at least these sectors give investors a fighting chance to keep up with cap rates that the Federal Reserve is forcing on the market. Further, compared to a Joe's Tacos, a portfolio of fractional interest in these types of properties can provide enhanced tenant diversification, geographic diversification, institutional property management, and built-in financing. On that last note, the types of 1031 investment programs that we offer include debt that requires no qualification, no application, no loan agreement, no personal recourse, no direct loan payments, no notary, no public record of your debt allocation, and no debt on your credit report. And yet, under IRS rules, you are able to replace the debt from your relinquished property. For some of our clients, this is the #1 benefit of investing in a passive replacement program compared to going out and finding your own property and securing your own financing, which is especially difficult when you're going and buying a fast food restaurant or a dollar store or some other similar single tenant triple net lease property. Okay, with that, I know we've got a little bit of time left. Alexandra, I'd love to be able to open up to Q&A and take a few minutes to answer questions if there are any.
Yeah, absolutely. So definitely put your questions in the question box if any of you have questions. Rick's info is on the screen here, but I will also be sending it to you tomorrow in an email, as well as the whole recording, so you could get in touch with him later if you need to. I'm not really sure if Tony was asking a question or not, but he said accelerated depreciation drops to 80%, not eliminated. That was maybe more of a comment than a question.
Yeah, you're right. There's not a complete elimination of the accelerated depreciation. So thank you to clarify. The ability to get a 100% write-off ends this year. There's a graduated schedule over time on the accelerated depreciation rules that are currently in place. So I did not mean to imply it was going away entirely, but this is the last year where you can get a 100% write-off on the assets that qualify for accelerated depreciation. Thank you for clarifying. Okay,
great. That was the only question I saw come through, but we could give it a little more time if you want to see if anyone else will come through with another question. In the meantime, what I can do is pull up a poll question. So if any of you do want to get a complimentary consultation to learn, if a 1031 exchange or, DST deferment strategy is best for you, and also, talk about some of the options that you might have, Rick would be happy and his team to get together with you and talk about that. And then if you say yes on this question, what I'll do is I'll let Rick know so he can sort of expedite that and make it a little easier for you to get a hold of their team. So I'll leave that up. And looks like we did get a couple questions. Carol saying, we bought a house in a 1031 exchange this year after selling a rental in Oregon. What is the holding period?
Can you read that question to me one more time?
Yeah, she says, we bought a house in a 1031 exchange this year after selling a rental property in Oregon. What is the holding period?
Ah, well, thankfully, there is no hard and fast rule on how long you need to hold a property for it to qualify for a 1031 exchange. This all goes back to intent. And of course, intent is a hard thing to prove one way or the other. But if you get audited in a 1031 exchange, and part of the trigger of that audit is that you bought a property and sold it in a short amount of time, you need to be able to demonstrate based on the paperwork at the time, because what other evidence do you have other than what's in your mind, that you bought that property with the intent to hold it indefinitely. And so the purpose of this is so that folks who do a bona fide 1031 exchange and then 6 months later get an offer they can't refuse on someone else who wants to buy that property for even more than they paid for it, you are not prevented from selling that property at a short amount of time, as long as at the time of the original purchase that you had the intent at that moment to hold that property for some indefinite amount of time. And as long as the IRS in auditing you doesn't find any paperwork that suggests that you had intended to turn around and sell that property, you should be fine. So if you bought a property last year in a 1031 exchange, and for whatever reason you have an opportunity to sell it now, you do not have to fear that your exchange is going to be reversed, as long as there's nothing to suggest that you knew you were going to turn around and flip that property at the time that you bought it.
Okay. Another question here from Raj. For the 1031, can you elaborate on the 180 days for completion?
Yeah, so the 180-day rule means that from the date that you sold your relinquished property, you have to complete the acquisition of your replacement property by that date, meaning you have to close. You have to be on title to your replacement property. Mm. And 6 months, obviously, in most situations, is far more than someone needs to complete the sale of a property or complete the purchase of a property. The reason that some people bump into the 180-day rule is there are folks who, and this is getting a little off topic from basic exchanging, but there's something called a construction exchange, where you're making improvements to a property while it is being held by the qualified intermediary, and you are delaying the acquisition of that property until the construction is completed, so that the total value of the property meets your replacement requirements. This is sort of an advanced 1031 strategy. Those are the situations where you might bump into the 180-day deadline for you to close. But for most AAOA members who own rental property, and you're selling an apartment complex or some other rental housing, and you're going on and buying a traditional property as a buy and hold, you are not going to be concerned with the 180-day close date. And as I mentioned, with our clients investing in Delaware statutory trusts for their exchanges, we get people reinvested within the first couple of weeks after they close.
Wow, that's fast. So Elizabeth asking for you to explain a little bit more about DSTs. Would you hold shares as a shareholder, a partner, or something else? And then when you sell the shares, how are you taxed? Do you need to do another 1031?
So great question. And I did not intend for this webinar to turn into a DST commercial, but I will tell you that when you invest in a Delaware statutory trust in a 1031 exchange, you are technically a beneficial owner, and you own what are known as beneficial interests, because it is a trust, and so technically you are a beneficiary or beneficial interest holder of that trust. And so at the county recorder's office, for whatever property you and 200 other people invested in, there's only one name on the deed, and that is the name of the DST. And so your ownership is not a public record. However, when you go to sell the property, and when I say you, I mean the DST, the individual investors are passive owners and they're not involved in the transaction. You're just waiting for the DST sponsor to sell the property. At that point, you have all the same options you have today, which is you can take the money and pay the taxes. You can take the money from the exchange and do a 1031 exchange into traditional real estate, or you can do what 90% of DST investors do when the property is sold, is you do a 1031 exchange and invest in another DST. So to answer your question, yes, when the property is sold, then your pro rata share of that property is then made available to you, and you can take that money and pay the taxes or do another exchange. And again, most people going into the DST process really just stick with DSTs for the rest of their life, because most of our clients, whatever property they sold to go into the DST was the last thing that they really wanted to own and manage. And now they want to just spend the rest of their life as a passive real estate investor. But there is no, while you're waiting for that property to sell, which on average is about 7 years, there's no opportunity for you to sell your interests in the DST. It is an illiquid investment, and you are just passive and along for the ride, waiting for that property to be sold.
Okay, great explanation. I think that clarified a lot. From SF Brown here, what type of property is recommended for a triple net lease in place of a residential property?
Well, again, for our clients, most of them are limited insofar as they're selling properties between $1 and $10 million. And most of those folks are really kind of in between the $1 and $2 million range. And then if you're not on the West Coast, you might have a $750,000 triplex or something like that. So most people in our market that are investing in DSTs are not selling multi-million-dollar properties, and because of that, your options are fairly limited in terms of your replacement property if you're not doing a DST. In other words, if you are going to just buy a traditional property, the types of properties that whose values are comparable to most folks properties that they're selling as rental housing landlords are they're fast food restaurants and dollar stores. To get into a higher caliber of triple net property like an Amazon warehouse, or an industrial complex, or a grocery store, a chain grocery store, or a grocery anchored strip mall, or something else that could have a single tenant triple net lease component. It's hard to get into the higher caliber of that real estate as an individual investor without investing in some kind of syndicated fractional interest program. So I don't know if I'm helping you with your question. It's really, it just comes down to how much are you investing, and are you willing to go outside of direct ownership? If you're willing to go down the DST path, then we do have single tenant triple net lease properties available. But like I said, these are 50, 100, $200 million properties with big institutional tenants, which are kind of a far cry from your small fast food restaurants and dollar stores.
Yeah, and those are typically going to be ones that are, I guess, safer investments, right? Less likely to default and whatnot.
That's right. And I thank you for saying that, because some of the risks associated with these smaller single tenant triple net lease properties can be mitigated insofar as you're investing with like an Amazon, for example. They're going to pay their rent, the second largest company in the world. But the cap rate risk that I talked about is still there in any single tenant triple net lease property. And so while we, through the DST approach, can help you invest in a triple net lease property that may be safer in terms of reducing your risk of cash flow being interrupted. Most of these properties still don't help you mitigate the main risk that I was talking about today, which is the risk that your yield on the property is not going to keep up with a rising cap rate environment. And really the only way to give yourself a fighting chance to have your NOI keep up with rising cap rates is to invest in those sectors that allow for continual revenue growth: multifamily, self-storage, senior housing, hotels. Those are the sectors that allow you on a sometimes daily basis to increase your rents.
All right, great explanation there. Amir asking, how does a reverse exchange work?
In a reverse exchange, you are making arrangements with a qualified intermediary to acquire a property on your behalf before you actually sell your relinquished property. And this is not an uncommon strategy. The reason that a lot of people ultimately can't take advantage of the reverse exchange is you have to have the capital that you need to buy your replacement property before you sell your relinquished property. And for a lot of folks, they don't have the extra hundreds of thousands or millions of dollars sitting around to go buy their targeted replacement property. And so, the fact that you can do a reverse exchange is really just a luxury they can't afford. But if you have the financial means to go and acquire the property that you want to buy as your replacement property before you've sold your relinquished property, then by all means, talk to a qualified intermediary. And of course, they're going to charge a lot more than the $1,000 fee for that, because now they incur the liability of holding a property for you while you're waiting to sell your rental property. So instead of $1,000 or $1,200, it might be $12,000, $15,000. But if you have an opportunity today to buy a property and that window is going to close before you can sell your current rental property, a reverse exchange is a great way to take advantage of the ability to hold that property while you're selling your intended relinquished property. Again, subject to your financial means to go out and buy that property.
Okay. Charlie asking, does the exchange, including any tax owed for boot, etc., need to go on the return for the year the relinquished property was sold?
So if I'm understanding your question correctly, that the tax consequences of your sale are all part of the return that you're filing for the year of the exchange. And now to the extent that you start an exchange in 1 year and complete the exchange in the next year, and then as a result of that transaction incur some taxable boots, and that has been incurred after you file your taxes. That's a good question for your accountant, as far as what year you're recognizing the boot. But again, I thankfully am able to say, when it comes down to the devil in the details, tax questions, to consult your tax advisor on things like what year is your boot attributed to. But I believe the general rule is that the consequences of the transaction are all realized in the year that you made the sale.
Okay, so CPA.
That's a great CPA question.
Yes. From Wei, if I exchange a California property to a Texas property, I am a Texas resident. Do I still have to file California return the years after I dispose of the California property?
Yes. Oh, I'm sorry, didn't mean to interrupt you.
I was going to say maybe another CPA question, but you seem to know.
No, this one I know. And there are other states that are following California's example in this regard, including Oregon, but California, as is not atypical, really was at the forefront of getting aggressive, partially because California is home to 35% of all 1031 exchanges. And
Wow.
and so the franchise tax board in California started to realize that the people who were selling California property and reinvesting out of state could then later potentially not do a 1031 exchange and ultimately realize the capital gains, and then California would never get paid on the taxes that they were deferred. And so this, in the minds of the franchise tax board several years ago, became enough of an issue where they passed a regulation so that now you have to report back, and I'm sure there are people who don't do this, but technically you are required to report back to California every year whether or not you sold the property that you exchanged out of, from the original California property that you sold. And the idea behind that is to help California track to see if you ultimately are ever going to pay them back for the capital gains tax that you deferred. Now, I'll tell you, for our clients, the idea is to keep doing 1031 exchanges until you pass away and to never pay those taxes, in which case, all California is ever going to get is an annual notice saying that you are continuing to defer your taxes, and they are actually never going to get paid. But the fact that you have to, file a form every year to let them know about that, again, I'm not sure how they enforce that rule for someone who doesn't live in the state of California to begin with. So I have no doubt that there are people who once they leave and are not actual residents of California and are no longer tied to the state from a tax perspective, other than having to file this form, that they may just decide to not keep sending this form in. But the rule is to keep sending the form in every year.
I see. Yeah, Carol is seconding that she sold a property in Oregon and bought in Texas and will have to pay Oregon taxes, even though Texas doesn't have state income tax. Same with rental income. So that is interesting that a couple states are doing that. Just goes to show you, I guess, how much these states want your tax dollars. And they're trying to make a statement, I suppose, more than anything.
That's right.
Okay, so Jeff asking, if I'm selling a multi-unit income property for a rental house, can I convert that rental house to my primary residence in the future? If so, how long do I have to keep it as a rental?
Yeah, this is a common question. And so the safe answer, the conservative answer is, if you do a 1031 exchange and you acquire a rental property that down the road you intend to occupy yourself as a personal residence, that you should have that rental, the replacement property, have that operated as a rental property, a bona fide rental property, for 2 years before you move into the property and convert it to a personal residence. That the general consensus among practitioners is that is you're not going to get into any issues if you hold it for 2 years. Anything short of that, so you're running the risk that in an audit, the IRS is going to come back and say, yeah, you never had the intent to really hold this for any length of time as an investment property, and disallow your exchange. So, just rent it out for 2 years and then you'll be good to go.
All right. Amir asking, back to the reverse exchange. In the reverse exchange, do you still have 180 days to sell your property from the date you bought your new property?
In the reverse exchange, when the deadline that we talked about, the timelines, the clock doesn't start ticking until you sell the property that you already own, your what we call the relinquished property, not the new property that you've got being held by the qualified intermediary, but the rental property that you already owned. Once you sell that property, at that point, now the 180-day clock starts to tick on when you can close the purchase of that property that you already have tied up. So you could hold that property for for months and months and months, for years even. But when we say hold it, it's being held technically on your behalf by a qualified intermediary. Technically, it's an exchange accommodator title holder, EAT. But anyhow, so there's no limit on how long you could have held that property for purposes of doing a reverse exchange, up until the point that you sell your rental property that you already own. And then it's the same 45-day and 180-day timeline as a traditional exchange.
Okay. Raj saying, let's say we did a 1031 with a QI by November, and we have 180 days and we file for extension for tax filing. Can we still qualify?
Yes, that's what you have to do. You have to do an extension. It's the filing of the taxes, the final tax return. That's what cuts off your timeline. So in your example, that's exactly what you would need to do, is file an extension. But of course, the 180 days, really the longest that can go would be 180 days from December 31st of the previous year. So that's taking you through the end of June, right? And so filing an extension by the April 15th deadline, which normally that means your next deadline for your taxes is October. So you still have plenty of time to get your taxes done. But yes, that is the approach that folks take, is you just file the extension. And for a lot of people, they're filing an extension every year anyhow. So but the reason I bring that up is you can imagine a situation where someone wasn't aware of the fact that filing your taxes cuts your time short, and you thought you had till the end of, say, May, and then you file your taxes in March and you just ruined your exchange. That could literally happen if someone wasn't advised about the limits. And
Well,
I'm sure it has happened.
I'm glad you brought it up. Yeah. Okay, well, that was the last question that we had. So I think from here, like I said, what we'll do is we'll send you all the recording tomorrow and the information that's up on the screen right now. And Rick and his team will get back to you if you requested any sort of consult. Thank you, Rick, so much for the time. And it's always nice having you. And you always speak so clearly on these topics. We really appreciate it.
Thank you. We look forward to our next seminar. And thanks everyone for joining. And if you have any questions, please reach out to us on our website, call our 1-800 number, send us an email. We'd love to talk with you.
All right. Take care. Have a good day, everyone.
Bye-bye.
Bye.